Hey everyone, welcome back to Corporate Dakota, where we unpack the financial secrets of the corporate world. And today, SouthState Corp's report looks like it's got some pretty interesting moves, especially with a big acquisition kicking things off this year. We're about to dive into how that shake up their numbers. Now, if you're interested in really understanding what's going on behind the scenes at companies like SouthState, hit that subscribe button right now. And hey, if you want to join a community that really digs into these reports, our Discord channel is linked in the description below, so make sure to check that out too. Let's jump right into their financials, looking at their balance sheet. As of June 30, 2025 means we're seeing the impact of that big independent bank group acquisition they wrapped up at the start of the year. Total assets have shot up to a massive $65 at the start of the year. Total assets have shot up to a massive $65.8 billion of last year. This acquisition significantly boosted their loan portfolio, with total loans net of allowance for credit losses climbing to $46.6 billion from 33.4. That's a substantial increase, showing how much scale they've added. What's really interesting is that the acquired loans, which were identified as having deteriorated credit quality since origination, make up a significant chunk now, over 33% of their total loans. And that acquisition cost, it's reflected in their goodwill, which has jumped from $1.9 billion to a staggering $3.1 billion goodwill, is basically the premium paid over the fair value of the acquired company's identifiable assets and liabilities. It tells us they paid a pretty penny to get this deal done. Now, let's talk about how they're making money. Their net interest income, which is the difference between what they earn on assets like loans and investments and what they pay out on liabilities like deposits, has seen a significant increase. For the second quarter, it's up to $507 quarter. That's a jump of over $77.790 million from $353 million, yields improving, partly thanks to what they call loan accretion. However, with more loans, especially those acquired with some credit quality concerns, comes a need for a bigger buffer against potential losses. The provision for credit losses, which is essentially money set aside for bad loans, increased to $7.5 million in the prior year. It's a good sign they have $5 million in the prior year. It's a good sign they are being prudent, but it also highlights the increased risk that comes with managing a larger, more complex loan book. Beyond interest income, their non-interest income also saw a healthy boost, rising to $86.8 million in the second quarter of 2025 from $75.75. This rise seems to be driven by higher fees from various banking services, likely reflecting the broader range of offerings from the acquisition. But all that growth comes at a cost. Non-interest expense jumped quite a bit, climbing to $375.1 million in the prior year period, an increase of over 50%. A big chunk of that jump is in salaries and employee benefits, which went up by nearly 50 million. That's operating expenses. They also saw a big increase in occupant intent, and it's clear that integrating a whole new company significantly impacts operating expenses. They also saw a big increase in occupancy costs and amortization of intangibles, which again points back to the integration of independent, and it's clear that integrating a whole new company significantly impacts operating expenses. They also saw a big increase in occupancy costs and amortization of intangibles, which again points back to the integration of independent. When you look at their profitability metrics, the return on average equity, which shows how effectively they are using shareholder money, was around 9.9% for the second quarter of 2025. Now, that might sound a little low on its own, but when you compare it to the return on average tangible equity, which is a bit of a Warren Buffett style metric that excludes those intangible assets like goodwill, it jumps to over 18%. This suggests that while the acquisition inflated their balance sheet with intangible assets like goodwill, it jumps to over 18%. This suggests that while the acquisition inflated their balance sheet with intangibles, the core operations are still generating solid shareholder returns on their tangible assets. It's important to note that much of the financial picture we're seeing is driven by the acquisition of Independent Bank Group. This deal has clearly changed the scale of SouthState's operations, bringing in billions in assets and deposits. They are managing that integration, and a lot of the financial movements we're discussing, like the jump in loans and deposits and the associated expenses, are direct consequences of that strategic move. When we look at the broader market, the banking sector has been navigating a complex landscape with interest rate hikes. and a fluctuating economy. While SouthState's acquisition seems timely, their ability to manage the cost of funds and integrate these new operations effectively will be key. Their strong capital ratios, well above the well-capitalized thresholds, provide a good cushion against potential economic downturns or integration challenges. Overall, SouthState appears to be executing a growth strategy through acquisition, and the initial numbers show a significant increase in scale and profitability, albeit with higher operating costs. The key for them now is successfully integrating Independent and realizing those synergies without taking on excessive risk. Their loan portfolio has become more concentrated in acquired loans, which, while boosting numbers, also brings with it inherent credit risks they'll need to manage closely. The strategy of replacing some higher cost local deposits with brokered or out of market deposits at lower rates is an interesting move in this interest rate environment, but it could be a double-edged sword if rates rise significantly. Now, what's your take on SouthState's acquisition strategy and these financial results? Do you think they're setting themselves up for success, or are there hidden risks we should watch out for? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate insights. And seriously, check out our Discord server linked in the description. It's the best place to connect with us and other viewers. Thanks for watching, and we'll see you in the next video.